Most people are entering investing with one simple expectation. They believe investing is about choosing something today and hoping it becomes more valuable tomorrow. This is how most beginners think. Buy low, sell high, repeat. But if you study how experienced investors operate, you'll notice something very different. They are not only focused on price movement, they are focused on systems that generate money continuously. Because in real investing, there are two types of value. One-time value, where profit comes from selling, and continuous value, where income is generated while holding the asset. The second category is what we'll call cash flow. Cash flow changes the entire emotional experience of investing. Instead of waiting and hoping, you are observing and collecting. Instead of predicting timing, you're analyzing activity. And instead of relying on market sentiment, you are relying on real-world usage. This shift is subtle but powerful, because once an investor understands cash flow, they stop thinking like traders. They start thinking like system observers. They begin asking different questions. What is constantly being used in the economy? What assets are repeatedly needed? What systems operate regardless of market emotions? And this is where alternative assets begin to matter. To understand cash flow, you need to understand where it comes from. Cash flow does not appear randomly. It is always tied to activity. Something must be used, something must be operated, something must be required by a business or system. This is why cash flow is deeply connected to the real economy. Think about it. Businesses do not pay for assets just to own them. They pay for usage. They pay for access. They pay for functionality. This means every cash flowing asset has one core requirement. It must be useful repeatedly, not once, not occasionally, but continuously. This is what separates cash flow assets from speculative assets. Speculative assets depend on perception. Cash flow assets depend on demand, and demand in the real economy is driven by necessity. For example, companies need storage space. They need transportation systems. They need equipment. They need logistics, infrastructure. These needs do not disappear when markets fluctuate. They continue operating. This is why cash flow investors focus less on market emotion and more on operational reality, because reality is more consistent than sentiment. People assume they are advanced or complex investments, but in reality, they are simply assets that operate outside traditional financial markets. They are usually tied to physical or operational systems. This includes infrastructure systems that support industries, equipment used by businesses, real estate that generates rental activities, logistics systems that move goods, industrial tools that support production. The key difference is not sophistication, it is function. These assets are not valuable because people speculate on them. They are valuable because they perform a job in the economy, and that job creates income potential. Another important concept here is visibility of use. In alternative assets, you can often identify who is using the asset, why is it being used, how frequently is it being used, what problem does it solve. This is very different from purely financial instruments where value is often abstract. This visibility changes how investors think. Instead of asking, will the price go up? They start asking, what role does this play in the real economy? Because roles are more stable than prices. To understand cash flow deeply, you need to see the economy as a system of movement, Nothing in the economy is static. Everything moves. Goods move, services move, capital moves, information moves. And behind all of this movement is infrastructure. Infrastructure is what allows systems to function continuously. Warehouses store goods so they can be distributed. Trucks transport goods between locations. Factories produce goods for consumption. Ports connect global trade routes. And every part of the system depends on physical assets. This is where cash flow emerges. Naturally, because when systems move, assets are used. And when assets are used, income is generated. This is the foundation of operational investing. It is not based on prediction. It is based on participation in ongoing systems. If you want to understand how deeply cash flow is tied to real-world systems, look at global shipping containers. At first glance, a shipping container appears simple, a steel box used to move goods. But in global economies, it represents one of the most important standardizations in history. Before containers, global trade was slow, expensive, and inefficient. After containers became standardized, global containers accelerated dramatically because now goods could be moved efficiently across countries, ports, and supply chains. Today, shipping containers are used across multiple industries: international shipping, domestic logistics, warehouse storage, construction site storage, industrial operations, retail supply chains. This means containers are not only limited to one function, but they are multifunctional infrastructure units. And this is where the cash flow model becomes important. Containers are not valuable because they are stored. They are valuable because they are used repeatedly across different sectors in different environments. This creates a usage-based system of value. And a usage-based system are the foundation of cash flow. From an economic perspective, containers represent something deeper. They are invisible infrastructure supporting global consumption. Every product you see in a store has likely passed through a logistics system that depends on containers. This includes electronics, clothing, furniture, food, and industrial materials. This creates a powerful insight. Even everyday consumer life depends on infrastructure that most people never really think about. And infrastructure like this does not depend on trends. It depends on global demands for goods, which means its relevance is tied to the real economy, not speculation. And this is why experienced investors often pay attention to assets like this, because they represent systems that remain active regardless of market emotion. Cash flow investors develop a different mental model over time. Instead of focusing on price charts, they focus on operational cycles. They ask questions like, how is the asset being used? What creates demand for it? How often that demand repeats? What risks affect usage, not price? This shifts their thinking from emotional reaction to structural analysis, because systems behave differently than markets. Markets can be volatile. Systems are usually stable in function, even if they fluctuate in input. This is why cash flow investors often feel less pressure. They are not trying to time exists. They are monitoring ongoing activity. And that reduces emotional decision-making significantly, because income becomes a function of usage, not speculation. At its core, Cash flow investing is not about finding better opportunities. It is about understanding how real systems generate value through continuous activity. Alternative assets matter because they exist inside those systems. They are not dependent on action, they are dependent on usage. And shipping containers are one of the clearest examples of this principle in action. Not because they're exciting, but because they're essential. They operate inside a global system that never stops moving, and that movement is what creates economic activity. And where there is activity, there is a potential for cash flow. Because in the end, investing is not about predicting what will happen next. It is about understanding what is already happening every single day in the real economy. Thank you for watching. If you enjoyed this video, don't forget to like, subscribe, and follow for more content on alternative assets, cash flow strategies, and long-term investing education. See you in the next one.